Hello everyone, and welcome again to Niddle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and I would also greatly appreciate if you consider supporting us as well. So please check the link in the description or click the join button below for more details. My name is Sava, and today we're investigating a quite heterodox, yet very practically popular with practitioners, that is, theory, that is, postmodern portfolio theory, or PMPT for short. And it has got its name by contrasting it with the modern portfolio theory developed by the likes of Harry Markowitz and William Sharpe and other famous names in the conventional finance paradigm associated with academics. Postmodern portfolio theory is more practitioner-focused, and it is mostly revolving around focusing on the asymmetry and non-normality of returns, rather than assuming that they're normally distributed and penalizing for risk in terms of standard deviation. So today we'll investigate postmodern portfolio theory and its applications on a selection of 6 stocks, and the benchmark would be S&P 500. Those are 6 well-established US stocks, large caps: JP Morgan, Walmart, Microsoft, Coca-Cola, Pfizer, and Caterpillar. So different sectors, all large caps, quite diversified, well-established portfolio that we'll be able to build using postmodern portfolio theory rationale. And we'll also compare it with the insights of the conventional portfolio theory, something like the Sharpe ratio optimization. Before we build anything, we have to calculate daily returns of our stocks and the benchmark, and we have got enough data to do so. We have got 10 years worth of data. So we could simply divide prices today by the prices yesterday and subtract 1. Those prices are total return indices with dividends reinvested, so we capture both the capital gains and the dividend component of stock market returns. And we can drag this formula calculation across. At the bottom, I'll click it all the way down to get all returns calculated. Now we'll be able to calculate our annualized historical returns by looking at holding period returns across a 10-year period. So for the JP Morgan, for example, this annualized historical return would simply be the last total return index value divided by the very first total return index value. Keeping in mind that we've got 10 years worth of data, we can raise that to the power of 1 over 10 and subtract 1. And we get 21.05% annualized return of JP Morgan. JP Morgan has done quite well in the recent 10-year period. We can drag it across and calculate historical annualized returns for our 6 stocks plus the benchmark. Obviously, most of the time for robust results, you do have to consider expected returns from some asset pricing model rather than just historical returns. As if you're using historical returns in your portfolio optimizer, whatever this technique is, you are implicitly assuming that past performance guides future performance, that momentum is present, and that you can extrapolate past historical returns into the future. And that's not always the case. So we could calculate betas of those stocks using their daily total returns against S&P 500, and using the risk-free rate. Most recent risk-free rate available for the US is 1.57% per annum. You can change that to multiple different market conditions, obviously. We'll be able to calculate expected returns as per CAPM. But there is also a modification of the CAPM in line with the postmodern portfolio theory that we'll investigate as well. So first, to calculate the betas, we can use the slope function and calculate the slope of our JP Morgan returns, for example, over here, against the S&P 500 returns in this rightmost currently column, locking the columns here as the market is the same for all 6 stocks in our selection. And we force this formula and see that at least part of this spectacular performance of JP Morgan could have been attributed to it being more risky than the market, with a daily market beta of 1.26 on average. And we can drag it across and calculate the betas for all 6 stocks, and for the market is just a sanity check. We see that the beta of market against itself is 1 by definition, and that means that we have applied the formula correctly. Always a good sanity check to have. And in terms of the expected returns, as per the conventional modern portfolio theory inspired CAPM, we would have the risk-free rate and we lock the column here for the risk-free rate, as it doesn't change for all of our stocks. They are all from the same market with the same relevant risk-free rate, plus the stock-specific beta times the market equity risk premium, which is the difference between the market return, and we'll lock the column, the market is the same for all 6 stocks again, they're all American, minus the risk-free rate, locking the column once again. And we have got expected returns as per CAPM for all of our 6 stocks. And we can see that, for example, Caterpillar has underperformed its expected returns over the past 10 years, whereas stock like Pfizer has slightly outperformed, and a stock like Microsoft has outperformed spectacularly due to the tech boom, as some of you might call it. However, the postmodern portfolio theory emphasizes the asymmetry of return distributions and the nature of downside risk. You are not necessarily interested in your stocks being correlated a lot or a little with the market on the upside, but you are very much interested in whether and how much they are responsive to the stock market behavior during downturns and panics at the market, for example. So here we can calculate the downside beta that has been actually quite a staple in the early academic research and then revived in the postmodern portfolio theory framework, that can be calculated as the slope of stock returns against the market returns, but only if the market return is below 0, when the market goes down, basically. To do that, we can use the same slope function we have got over here, but impose an if function on top of that. We will take our data, our returns, only if the market returns that we've got over here are less than 0. Then we take the stock returns and we report nothing otherwise, so that our slope is basically filtering the data set for only negative market returns. And we impose the same condition on the market returns as well. And that allows us to calculate the downside beta of JP Morgan and all other stocks likewise. And we have got 1.24 as the downside beta for JP Morgan, meaning that those two betas are quite comparable. We can drag it across and see whether there are some notable discrepancies. First of all, Coca-Cola is not as defensive of a stock as it might seem from its traditional beta. Its downside beta is quite a bit higher. And Caterpillar is not as risky as you might feel, as its downside beta is closer to 1 than its simple conventional beta that's quite a bit higher than 1, which is an interesting finding to process. And as you might have already guessed, the downside beta allows you to calculate the expected return as per the downside beta CAPM, which is simply the same formula that we can copy across, substituting the downside beta in place of the conventional beta, having an updated estimate of our expected returns. Now, we can finally input our baseline weights, which would be an equally weighted portfolio. It's always natural to start with 1. And we can figure out the expected annual return for our portfolio with set weights. And let's start with the conventional portfolio theory and then introduce the postmodern portfolio theory techniques to compare the results and the optimal weights that would arise from these applications. So for the annualized return of our portfolio with CAPM, expected returns, we can use sum product, the sum product of weights and CAPM returns. And then we can simulate our portfolio with set weights using historical daily returns. And so here we use the sum product function, refer to these weights, lock in the rows as the weight stays the same throughout. And then we refer to the daily returns we have calculated over there, not taking the market return, as we are investing only in stocks and the market is there for the comparison. And that will give you the returns of the portfolio throughout the 10-year period, which means that we can calculate the average historical daily return. Here we use the simple average to calculate various variance and asymmetric downside-upside variance statistics. So here simple average and not the geometric mean, for example, will do. And now we can calculate our portfolio volatility, which would be the sample standard deviation of those portfolio returns times the square root of 252, as we are annualizing our standard deviation, and there are 252 trading days in a year in the US, which gives us an annual volatility of 16.34% for our equally weighted portfolio. However, for the postmodern portfolio theory, you emphasize penalizing your portfolio manager for taking on downside risk, but not taking on upside volatility, as investors are not that averse necessarily to potential of an upside in excess of some of their return target. So here, for downside risk, it's very crucial to figure out what is your target return, and that implicitly accounts for the risk tolerance and the risk aversion of your investor. For example, someone who is very risk averse might have a target return of not that much higher than the risk-free rate, for example, a 2% annual target return that would correspond to a daily target calculated this way, using simply the geometric mean of roughly a basis point a day. However, someone who is less risk-averse, more risk-tolerant, would potentially want a target annual return of 10%, corresponding to a target daily return of 4 basis points. And that can be used to calculate the downside volatility, that then can be used to implement the Sortino ratio, that would be the Sharpe ratio lookalike from postmodern portfolio theory, that would have the outperformance of the annual target in the numerator and annualized downside volatility in the denominator. And here is where there is a very important distinction in postmodern portfolio theory between downside volatility and the asymmetric variance, which in postmodern portfolio theory is dubbed volatility skewness. For volatility skewness calculations, and we'll proceed to them a little bit later, you use the mean, the average historical daily return, to calculate your upside and downside. For the Sortino ratio and the downside volatility, you use the target instead of the average historical return. So bear in mind this distinction when you're implementing a postmodern portfolio theory optimization. So let's do both. For our downside volatility, we need to calculate the maximum of the target, daily target, minus the portfolio return. So basically, we are returning a value only if we have underperformed our daily target on this particular day, and 0 otherwise. So here we see, in the very first day, our return is coincidentally 0, so we have underperformed our target by roughly 4 basis points. In the second day, we have underperformed our target by 2.03%, given the fact that our return has been negative. However, when our return is sufficiently positive, we return 0, as this is not a violation of our target. We're happy with this result, and we would not count that when calculating our downside volatility. Now, for the upside and downside variance, for the volatility skewness calculations, we need to use the historical daily return. For the upside, we can calculate the maximum of the portfolio return minus the historical daily return, and 0. And for the downside, we can calculate the maximum of the historical daily return minus the portfolio return and 0. Meaning that here, for example, as we under-delivered our historical average, we have got a downside of 7 basis points, 0.07%. And now, having calculated these formulas for all 3 columns, we can enforce them throughout our 10-year sample and calculate downside volatility as well as upside and downside variance. So for the downside volatility, what we need to do is we need to sum squared our underperformances below the target, which take target annual return and target daily return respectively, and then we have to divide it by how many observations we've got minus 1. That would give us the variance for this underperformance below the target, and to get the volatility, we can obviously take a square root. And that would give us daily downside volatility. However, if we need to annualize it to make it comparable to our other volatility figures and our return figures, we can multiply by the square root of 252, annualizing it in the same manner. And we have got 11.45% downside volatility. meaning that 2/3 of the volatility of this portfolio comes from the downside, which is very typical. And now, for the Sharpe ratio and Sortino ratio, we need to implement the respective risk-adjusted return procedures. For the Sharpe ratio, we subtract the risk-free rate from our annual return and divide it by annualized volatility, getting a Sharpe ratio of 0.83. And for the Sortino ratio, we need to subtract the target from our annual return, subtracting annual targets from annual returns, and dividing it by the annualized downside volatility, giving us a figure of 0.45. For Sharpe ratio, we have got 0.83% return in excess of the risk-free rate per 1% portfolio volatility. And in Sortino ratio, we have got 0.45% outperformance over our target per unit of downside risk we are taking. These are the interpretations of the two ratios. For volatility skewness, we need to calculate upside and downside variance, and that's easy enough to do. We need to sum squared the respective column, the upsides or the downsides, divide them by the respective counts, and as we are dealing with variance, we can leave it without taking the square root. And that gives us the figure for the upside variance. For the downside variance, we can simply copy the formula and drag the column reference across. And for the total variance, we can simply use the variance.as sample variance function, applying it to our usual run-of-the-mill portfolio returns. And what we can see, which is quite nice, is that the sum of the upside variance and the downside variance over here is the total variance. So they in sum together and give you the conventional variance estimate. So it means that the percentage contributions of upside and downside to the total variance sum up to 1 or 100%, which means it's very easy to interpret. For example, if we divide our upside variance by the total variance and we lock the row over here, we get 48.83%, and for the downside variance we get 51.17%, meaning that 49% of our variance comes from the upside and 51% comes from the downside, meaning that more variance of this portfolio, more of its risk is downside related, which is alarming in terms of the postmodern portfolio theory interpretation. And the metric that postmodern portfolio theory uses to quantify this asymmetry is volatility skewness. It is not necessarily the skewness parameter that we know from conventional mathematical statistics, but rather it is the ratio between those two percentages, which gives us 95.42%. If volatility skewness is below 1, it means you've got more downside than upside. If it's higher than 1, then you have more upside than downside. Postmodern portfolio theory advocates argue that this representation of the asymmetry of the return distribution is more intuitive than that given by the conventional skewness parameter. Before we run any solver applications, we have to apply a condition that the sum of weights should be equal to 1. So here in this cell, we can sum up all of the weights that we've got here and make sure that an equally weighted portfolio, 1/6, when you've got 6 stocks, does indeed sum to 100%. Good sanity check. And now we can click Solver and start inputting our optimization task. First of all, we need to maximize our Sharpe ratio in terms of the conventional portfolio theory, modern portfolio theory. We need to change our weights, so variable cells representing the 6 stock weights, subject to the constraint that our sum of weights in this cell over here is equal to 1. And that's the only constraint that we need. We can leave this box ticked as we don't want to short any of the stocks necessarily, and resort to the gradient descent algorithm, GRG nonlinear, click and solve, and waiting until the algorithm converges to optimal portfolio weights. And here we see that we've got quite a diversified portfolio with large exposures to Microsoft and JP Morgan, given their high expected returns here, and the stock we've got least exposure to is Walmart with 9%. So this portfolio is quite diversified. Let's see what would happen with postmodern portfolio theory portfolios, starting with someone quite risk-averse with a target return of 2% per annum, and with downside cap expected returns. If we click Solver, and now we would like to optimize the Sortino ratio in cell V19 instead of the Sharpe ratio, we can simply click Solve, and we see that this portfolio is quite a bit less diversified, as we not necessarily value the volatility, the standard paradigm that favors diversifying your portfolio and reducing exposures, but rather valuing skewness, upside versus downside. And even for someone quite risk-averse, you have got quite high exposures, higher than in the Sharpe ratio case for a stock like Microsoft, for example, simply because upside is valued quite a bit when you're calculating the Sortino ratio. The amount of volatility that comes to the right-hand side of your target is not counted when you are adjusting your return for risk. However, if someone is very risk tolerant at 10% annual target, someone who really wants to perform well, then we can recalculate our Sortino ratio and see that our new optimal portfolio is indeed very heavily concentrated, almost 50% in Microsoft and more than 50% in JP Morgan, which tells you that indeed investors with various preferences and with various return targets can go for very concentrated bets and still achieve the desired outcomes, which is one of the contributions of the postmodern portfolio theory into the discourse. Also, we can look at the volatility skewness and see that it is improved compared to the equally weighted portfolio. Now the contributions of upside and downside variance to the total variance are almost equal, which means that indeed we do favor those two stocks, not only because they provide high returns, consistent with our quite high target, but also because they provide positive skewness to our portfolio return distribution. And that's all there is for the implementation of postmodern portfolio theory applications in Excel, such as the downside beta, Sortino ratio, and volatility skewness. Please leave a like on this video if you found it helpful. In the comments below, I make this any further suggestions for videos in business, finance, or economics you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.